Well, joining me right now, Florian Neto, Head of Investment Asia at Amundi, joining in on the show right now. Florian, hi. Good to be speaking with you as always, and have to talk about India's union budget tabled yesterday first. Wanted to understand from a global investor's perspective, Florian, is this budget more market-friendly or growth-supportive? And would it want to make FIIs come back to India finally?
Thanks. Good morning. Thanks for having me. Yeah, indeed. Well, the background before the budget yesterday was that foreign investor interest had been relatively subdued on India. It was very much not because of the rupiah weakness in our view. It was very much because of the no trade deal with the US so far, and as well because commodities going up was putting pressure on margin. Everything was about AI, and the trade in AI in Asia was very much towards Korea, China, Taiwan, and less so with India. So on the budget announcement yesterday from Finance Minister, frankly, from a foreign investor point of view, the base case scenario was that it would have been a non-event. We got eventually the limited fiscal consolidation that we were looking for, so 4.4% fiscal deficit. When we look into the details of the revenue assumption, it was quite conservative. What is positively taken from us is the moderate increase in Capex. We noticed as well that there had been a rotation from services into defense, into semiconductors. But as it was already mentioned on your show, the market reaction was very much on the security transaction tax hikes that was unexpected, the fact that buybacks as well will be taxed going forward. So this is actually a question mark from foreign investor is how would it be taken by domestic market participants? We know that foreign investors have been absent from the market and the flows have been essentially going out for the last 6-9 months now, but domestic investors were very strong. So the point now is there could be near-term headwind because of this budget linked to this security transaction tax. And how we will monitor this is how it will have an impact on the liquidity. So do we have any change in the SIP flows? Do we have any impact on the volumes? On option, but we don't really think that it will be very negative. We do believe that what happened yesterday has been a bit of another shot to the downside. And when we look into Capex increase in infrastructure, some incentive we have in semiconductors investment, all this is quite positive. One point on the sector level, when we see defense stocks down yesterday, we were quite surprised because for us, they should be medium-term beneficiaries.
So at what point, Florian, would the mood on India change? Would it have to be after a deal with India and US, the trade deal that is? Would it have to be more currency related a move? Or would it have to be more about, just relative performance when other emerging markets become more expensive in relation to India? And that's when do you think that money will flow back into Indian markets?
Yes, it's a good question. I think a bit of two angles. One angle is when we see India having deals with the US, okay, this is something we are looking for definitely, but as well, the big announcement last week of the EU-India strategic partnership. When you look into it, you have the second economy and the fourth economy, so basically 2 billion people agreeing on a free trade. So it's a very positive to get strategic autonomy. It's a very positive to get a bit more reliable supply chain as well. So this is a good point. The second area is definitely what you were saying in relative terms. In relative terms, typically when you look at India, you look at earnings that we got on the September cutoff, so the Q2. It was really positive and it was showing a bit some strength. The recent data we are getting for the December cuts is a bit less positive in relative terms versus other areas. So my point is the market is currently pricing an extension of the cycle and an extension of the cycle with a lot of liquidity because we have an expansionary monetary policy, we have an expansionary fiscal policy in the pipe, regulatory as well is getting a bit more positive and expansionary. So at the end of the day, when you look at the risk of hard lending is close to zero. So everybody is trying to get a participation into the AI story. So we are not denying that the AI-led investment super cycle is there. We are not denying it will have a very strong impact on productivity, but we are a bit concerned about the concentration risk. So I guess what we are seeing today on the market with erratic moves from Friday and today on gold, for example, on silver, but as well some markets that have been performing very well in year to date, say Korea and China under pressure, you see that a lot of market participants behind this rally have been actually weak hands. speculative hands. On gold, typically, we've seen that gold have been performing very well during Asian hours, more specifically. So there is a bit of speculative. This can eventually, at the margin, helps India to recover in relative terms. But we need to have a catalyst. And so far, it's not coming from the budget in our view. It's a medium-term positive, but not a very short-term one. And we need to see a bit better earning growth as well in India, so that from a relative term point of view, foreign flows will reallocate to the country.
If you look at the kind of capex outlays which have been given, and you mentioned yourself that for defense it's been a decent capex which has come in. Do you think that the sell-off that we saw yesterday for public sector banks, defense stocks, metal stocks is a little overdone, and it's an opportunity for many foreign investors?
I think from foreign investor, thank you. It's definitely at sector level. When you look into how the increased government spending, where is it going to? It's going into definitely construction, cement companies. So those are the ones that can benefit. The biopharma has been confirmed as a long-term commitment. This is something that is quite interesting for us in our portfolios. We do invest in biopharma, India, but as well in other countries. So this is another point that is interesting. Definitely, if you're a broker company today, or if you're a custodian bank or the exchange, well, the STT news on derivatives is not a positive news. So I think this is one of the market reaction where we would have actually expected this. Another point on the public sector banks, I think the expectation is potentially with this capex to have higher government bond yield. I do believe that if there is higher government bond yield, foreign investor will step in to buy. They will buy as well NBFC. They will buy as well some high yield renewable bonds in India. So I do believe that the public sector banks and the performance of yesterday is a bit another shot as well to the downside. So in general, we do like banks in India in our portfolios. And the last point is on defense, but I did mention already, I think defense stocks are quite interesting. It's not only in India, it's in Korea, it's in Japan as well. So we have a bit of a regional approach through this sector. But the fact that they underperformed yesterday was a bit of a surprise to us, and it will be an opportunity to buy indeed.
Very interesting. So Florian, defense is clearly something you've said a couple of times. You've reiterated that. Point taken home. But talk to us about what else really stands out for you in terms of India and Indian valuations. Anything that's looking attractive in relative terms, or which has been beaten down unnecessarily, as one would call it, which happened in defense yesterday?
Not really, frankly. We are looking into some construction names. We are looking into some defense names. We like the banks in general. We see a switch from consumer into more infrastructure, into more semiconductors. So there is an interesting play from India to try to be part of the AI story, to be part of the AI supply chain. And this was one rhetoric that was missing as a catalyst for India in the recent months. We have to monitor further how it will eventually be taken by foreign investors, but those are good initiative in general. And in our portfolios today, in terms of diversification, so in a global portfolio, what is interesting to see is that when you have a MSCI All Country World Index and you have to follow this as a benchmark, you have 3% allocated to India, and you have 3% allocating to China, and you have 65% allocating to the US. So the big thing we have in mind, and it's not new, we are very convinced that an investor should diversify their allocation, and this is how we build portfolio. So basically, you should diversify within the AI supply chain. So typically, you should expand from the hyperscaler into utilities, into industrial companies that will produce faster and cheaper, and those industrial companies can be in India as well. You should expand in terms of geography. Last year is the first year in the last decade almost that EM equities outperform US. We do believe that we are comfortable with an overweight EM to start the year with, and we will stay like that for this year. And we have been adding moderately to Latin America equity and to India of late, on top of our overweight on Korea and China we have in portfolio. And the last point is on market cap. So on market cap, I think our strong conviction is you should underweight mega caps that are taking too much of an exposure at your global portfolio level. You should overweight some large cap in the US and small and mid cap in Japan and in Europe. We are seeing some good profitability there. You have relatively high beta and high cyclical stocks that are not really growth oriented, but that are more financial, industrial, defense stocks. So this is how we are constructing portfolio today.
Interesting. Florian, great to have you today on the show. Thank you so much for your time. Such great insight from you today.
Thank you. Have a good day.